Hello, Assalamualaikum and good afternoon. Okay, our group will present on the case study for Nike and Teletech. Our group consists of me, myself, Muhamad bin Mamat, Muhammad Shafiq Mokhtar, Zulfika Arsad, Fitri, Shah bin Bakar, Amir Azahar, Choo, Xiang and Tharsyini Annathurai.
Hi, my name is Shafiq. In this case, I'll be presenting the case study number 1, Nike. Well, as an intro, as a background, we do have the Kimi Ford, the portfolio manager of North Point Group, trying to make a decision on buying and selling of Nike share as part of managing her fund portfolio. Based on the report available, Kimi analyzed and conclude that the Nike share price at 42.09 is overvalued after 12% discount rate being applied. However, to increase the certainty, Kimi requested her assistant, Joanna Cohen, to reanalyze the stock. And Joanna indeed came out with the different conclusion. The first one would be Nike cost of capital using the WACC model, computed to be at 8.46 at the future discount rate. Number 2, future forecasted price is expected to be higher than 42.09 from Joanna calculation, thus buy is the recommendation. Beyond that, after looking at the details, we did look at the computation from Joanna. We have a couple of agreement and disagreement in terms of how Joanna conclude the data. The first one, capital cost of Nike, we agreed it does have 2 elements, which is the cost of debt and cost of equity. So we agree with her using this computation in the WACC. Number 2, the CAPM is a suitable and better method to compute the cost of equity. Number 3, the beta of 5 years are sufficient and valid parameter in this case. We do also look at the disagreement of 2 pointers with Joanna. The first one, we disagree that the debt computation is taken directly from the balance sheet, but instead we requested, or we believe the calculation is supposed to be based on the bond value since the debt was funded by a bond issuance. The second part, we also disagree in terms of the way the weightage computation being done. We believe it should be using market value for cost of debt and cost of equity instead of the book value. That's all from my end. Let me hand over the floor to my counterpart.
Now we're going to compare the calculation using the book value by Cohen and our market value, our analysis. From this comparison, we can see that the different approach lead to different results in the variables that would be the deciding factors in analyzing the portfolio. Cohen is using book value, which the approach is based on the net value of the firm's asset that can be found in the company's balance sheet. So this represents the total amount of money received in the event they liquidated the company after paid off all liabilities. Meanwhile, our approach using market value is valuing the company worth based on the total value of its outstanding shares in the market, which is market capitalization. In Cohen's analysis, the value of equity is derived at 11.427 million. While we using market value approach, it will give us 11.5, which is higher value, and it considers average shares outstanding rather than the current shares outstanding. So contrary to the equity value, the value of debt is valued lesser in the market value approach, as it does not take into account the current long-term debt, and then this value affect the weightage of the debt and equity consecutively in our analysis. And for the cost of debt, using market value resulted to higher cost of debt at 4.44% compared to Cohen's cost of debt at 2.7%. So for the cost of capital, we agree with Cohen analysis using CAPM as the basis. And the different approach saw that the WACC for Nike is higher based on our assumption made with 9.8% compared to Cohen analysis using 8.4%.
Hi everyone, I'm Amir. I will explain about CIPM, DDM, and also advantages and disadvantages by using CIPM to calculate cost of equity. Based on the financial performance on the night, the risk-free rate is 8.74 and beta value is 0.83. We got from the 5 years in historical beta. The risk premium rate is 5.9%. So the total the cost of equity is equal by risk-free rate plus beta value and times the risk premium rate equal to 10.64%. For dividend discounted model, we got from the Nike financial performance, the dividend growth rate is 5.5%. Cost equity we got from the CAPM model, 10.64%, and dividend previous year we got 0.48. To calculate the dividend discounted model, is equal to dividend previous year times 1 plus growth rate of 5.5%, divided by cost of equity minus growth rate 5.5%. We get 9.85 for fair value of this company. So the advantages use CAPM calculate cost of equity is the CAPM only takes account in systematic risk, and CAPM is much better than the dividend discounted model because DDM consider only a company's level of systematic risk, not as a whole market. Disadvantage by using CAPM, the risk-free rate is not fixed and fluctuate in response in the economic condition. For the equity risk premium, this will impact if the share price is declining and the stock market will be a negative return. For the value of beta is not constant, so they will get uncertainty in the expected return value for the project or the investment.
Hi, Doctor. This is Tharsyini here, and let me explain about the portfolio recommendation. And I would like to thank Mr. Shafiq to guide me on throughout this process. The above calculation is a discounted cash flow (DCF) analysis of Nike's cash flows over the next 10 years, discounted back to present value using the company's WACC of 9.85% by dividing the estimated total value of Nike's equity by the number of shares outstanding. A price of $44.14 per share can be calculated. Based on this discovery, we can conclude that Nike's current shares price, $42.09, is less than the future value per share of $44.14, indicating that the stock is about 5% undervalued. So she advised to buy the stock. Then let's go to the conclusion part. Kimi will be able to make money for the fund portfolio she manages if she follows through her plan to buy undervalued Nike shares right now, according to her calculations. Other things like the appearance of new competitors and the way people see and value brands changing all the time may be worth thinking about when deciding whether or not to hold on the stocks in the medium and long term. Thank you. That's all from me.
Okay, next, second selected case is Teletech. We will present three main topics. First is synopsis and objective, case analysis, and conclusion. For the synopsis, in 2005 October, Chief Financial Officer were asking by corporate raider to formulate a response towards a claim of unprofitable by all major business segments. Hence, there is a debate which single hurdle rate as a cost of capital versus risk-adjusted hurdle rate system. So before we go detail on the case analysis, several main objectives have been highlighted. The first one is to review the classic argument against a just hurdle rate system. Second, to assess the assumptions and limitations of risk-adjusted hurdle rate and exercise the estimation of segment WACC, expand risk-return analysis to the corporate finance, and the last objective is to consider possible organizational barrier to the implementations of risk-adjusted hurdle system.
We go to the case analysis. The first one is a hurdle rate, which is a cost of the capital. The hurdle rate currently used serve as minimum return on investment standard for both operating division, which are first is the telecommunication service division and the product and system division. Next, in order to achieve the objective of this case analysis, we have to estimate the WACC criteria. From Exhibit 1, the WACC given is 9.3 for the corporate one. So to complete the case exhibitions, we estimate WACC for both segments by using debt and equity calculation. Telecommunication service WACC is 8.47%. And product and system segment show WACC is 11.73%. Therefore, it actually indicate that investing in the telecommunication service area, which have a lower absolute return but a higher relative return, will create value for Teletech investor as suggested by corporate raider in the case. The key assumption in this context is that investor will monitor change in riskiness of the company asset and modify their needed returns accordingly.
Hi, Assalamualaikum. I'm Zulfika. I will assess of the constant versus risk-adjusted hurdle rate based on the risk-Philip interpretation graph. From the graph, we can see that risk-Philip emphasis constant hurdle rate can result in the acceptance of bad investment. This can show which is product and service falls in the area on the graph which is below than risk-adjusted hurdle rate. Second, constant rate can be result in the rejection of good investment. We can see that telecommunication service falls in the area of below than the constant rate line. Thirdly, if the investment opportunity roughly form an upward sloping cloud in risk-return space, constant hurdle rate can result in the naive risk shifting in the pursuit of higher return investment, which is to the right side of the graph. From the previous calculation, it's revealed that the WACC for the product and service is 11.73%, while the WACC for the telecommunication service is 8.47. In perspective of return, 11% of product and services we can it can't perform as Yozarian's suggestion. Meanwhile, for the telecommunication services is more profitable to investor with the return of 9.10%. The numbers that calculated show fairly consistent with the risk-return graph that created by the risk Phillips. Next, I will go to the risk-adjusted hurdle rate implementation issue. The first implementation issue is the organizational politics. The implementation of the risk-adjusted system will lead to the higher valuation of the firm. This will serve the interest of all stakeholders. Change in the hurdle rate system will create a winners and a loser within the firm. Politics in organization may be the severe barrier of this implementation. Secondly, issue is about the estimation. Realizing the assumption of independence and treasury considerably complicated the task of estimating the segment in WACCs. The third issue is organizational changes. We need the larger effort to transform a cultural towards a more investor-oriented point of view. This will need a lot of effort like communication, training, compensation, and change of the organizational structure.
This is the equation for economic profit. Teletech adopted this measure of value creation for use at the segment and business level unit. Using the equation of economic profit, we can calculate that if the combination of telecommunication services and products and systems have 44.8 million, which is not as high as telecommunication telecommunications services on its own, which is 100.8 million. Products and systems is on the negative side, which is much worse than the rest. Since the telecommunication service on its own is much higher for the economic profit, it will be better to sell off the products and systems segment, which is on the negative side, and focus more on the telecommunication service side to create more value at the end. This will generate much more profits in the long run and not misusing any resources. Okay, thank you.